Very good morning to all of you. I hope all of you are doing well and safe. On behalf of Next Time and Economic Point, we welcome you all at this virtual knowledge dissemination session on UAE corporate tax. For next 90 minutes, we plan to talk about, interact, take you through the intricacies of UAE corporate tax. And I thank all of you for joining us today, and I'm sure all of you would help us in making this a two-way learning and an interactive session. For this session, we have with us Nishit Parekh, who is partner tax with Sudip K. Parekh & Co. LLP. He is a Master of Commerce from Mumbai University and member of Institute of Chartered Accountants of India, with over 13 years of experience in advising several domestic and international corporates on the matters relating to international tax, FEMA, and structuring of inbound and outbound investments. Nishit also has experience in handling a wide range of cases at various levels and has extensive experience in income tax, international tax treaty provisions, and FEMA. He has also authored numerous articles, including topics such as indirect transfer of shares, business connection, BEPS, service fee, etc., which have been published in major industry journals such as International Tax Journal, Taxman, and Tax Sutra. He's a regular speaker at various industry forums organized by the Chambers of Tax Consultants, ICAI, Indo-French Chamber of Commerce, and Indo-American Chamber of Commerce on various topics, ranging from overseas direct investments to international tax and FEMA. Thanks, Nishit, for joining us today. We also have with us Trupti Mehta, who is Director, Setup and Expansion for the GCC region at Next Time. She leads all business development activities in the GCC region and is responsible for growing the company's presence in the said geography. She actively coordinates with the Next Time's clientele within Dubai International Financial Center and Abu Dhabi Global Market, and has over 20 years of experience in statutory internal audit as well as consulting services for various industries, including engineering, construction, financial services, legal, etc. She has led numerous consulting assignments across sectors and has expertise in handling audits, financial reporting, internal controls, financial analysis, financial accounting, and corporate finance. For the GCC region, she assists clients with their regulatory filings such as Economic Substance Regulations, Foreign Account Tax Compliance Act, and Value-Added Tax. She's also well versed with the regional data protection laws and has a thorough understanding of all DIFC and ADGM related regulations. Thanks, Trupti, for joining us today. Audience, the way you can interact with Nishit and Trupti for next 90 minutes is you have an option of a questions box. You can type in your questions over there and we would address those questions as and when we pause during the session, or you can raise your hand and we'll unmute you for an interaction with Nishit and Trupti. With this, I would hand over to Trupti.
Thank you, Ashish. And good morning, everyone, for joining this webinar, which is a very important one. Come 2023, and UAE is going to implement the corporate tax. Now, just to set a little background that why corporate tax in UAE is because Organization for Economic Cooperation and Development, that is OECD's mega plan for international collaboration to end tax avoidance, is reflected in the inclusive framework on BEPS and two-pillar plan. Now, UAE is one of the participating jurisdiction for BEPS. Consequently, introduction of the UAE corporate tax regime was inevitable to execute global minimum effective tax rate proposed under Pillar 2 and broadly to stick to its commitment towards tax transparency. While you must have seen that UAE is trying to shade its image as a tax haven and have taken various steps after joining the BEPS framework in 2018. UAE immediately adopted ESR in 2019 to have a check on the companies who have set up the business in UAE and to have a check on the companies who are functioning without any substance. Post that, now we are hearing the news on corporate tax in UAE. So now how the government is planning is they have introduced the tax coming into the on 31st January 2022, and now they have come out with a public consultation document which gives a brief on the tax proposal, which will have a fine print of the proposed law which is going to come, and they are going to ask the stakeholders about the suggestions or their inputs on the consultation document. Overall, the approach has been very well planned and is now being actioned through proper steps. But there may be few areas where the corporate would like to plan and execute before the tax law kicks in. The public consultation document covers provisions for taxability of business income earned from operations in UAE as well as capital gains. It also covers special scope for free zone companies. The outline of law appears to be aligned to its principle of simplicity and neutrality. However, as you know, as always, the law would have its own nuances and interpretational issues. So that is where I would like to invite Nishit to explain us the key concept and possible issues which may arise. So Nishit, I hand it over to you.
Thank you. Thank you, Trupti, and thank you, Ashish, for setting the background and giving a wonderful introduction. And good morning to everyone who has logged in today to listen to me on the UAE corporate tax. So, as a coverage, what we will try to understand during today's session is that what is the background as to why UAE corporate tax came into picture, who is covered under UAE corporate tax, what is the overall taxation regime, what is the tax rate, what are the provisions for deductions which are allowed, what are the losses, what will happen to the losses, what is the implication on free zones, what is the concept of tax group, how transfer pricing would apply, what is the administrative aspect of this entire corporate tax law. And as we all know, and also like Trupti pointed out, the law is introduced as a part of one of the measures taken by UAE, uh, being a part of the inclusive measure and to implement the pillar 2 approach. So how it will impact, whether this covers everything or whether there is anything left which needs to be covered. And lastly, few case studies, time permitting, as to what could be some practical scenarios which companies need to watch out for. So starting with an overview, see, as a part of UAE's commitment, UAE has been taking steps from 2018. In 2018, VAT was introduced as per Action Plan 1 of the BEPS project. Then came ESR in 2019, and now corporate tax has been introduced. So the key criteria or the key objectives which have been put across by the authorities is that they want to cement UAE's position as a leading jurisdiction for business and investment. So more and more to come out of the image of a tax haven, lot of measures have been introduced, including ESR, VAT, and now corporate tax. Idea is to keep this tax very simple so that it is easy to implement and not a lot of impact happens on the businesses. But there may be certain areas where there could be possibility of litigation, controversy on the tax law side. So the nice thing which the authorities have done is that they have not immediately introduced the law. They have first issued FAQs in 2022 January. Then they came up with a public consultation document in April 22, for which suggestion from all stakeholders and taxpayers were invited to be submitted by 19th May, which people have submitted to try and see if the open items or the areas which could result in possible litigation can be plugged. Our expectation is in next 2 to 3 months, we may have a draft law being rolled out, and then the finalization will happen towards early next year. So implementation date as provided under the FAQs as well as under the public consultation document PCD, if I may call it, was that it will apply to any tax year beginning post 1st of June 2023. So for a company which is following a calendar year as their financial year, first period for which tax would apply would effectively be the year 2024, that is for the period January 2024 to December 2024, and for that first compliance would kick in on 30th September 2025. So this would is a broad timeline as to how the law would apply. Now coming to what is the scope of taxation, who would be considered as taxable, who would be considered as an exempt person. So from a taxation perspective, any legal person incorporated UAE would be covered under the scope of taxation. So that would include all your companies, firms, LLP, unincorporated joint ventures, all of that would be covered under taxation. Individuals are out of the corporate tax of UAE, so there is no personal tax unless that individual is carrying on some business or commercial activity which requires a commercial license in UAE. So if you are carrying on an activity and you are required by law to apply for a commercial license, then UAE corporate tax would be applicable. Otherwise, on your personal income like salary, interest, dividend, or capital gains, there would not be any tax in UAE. Then limited and general partnership, including unincorporated JVs, would be taxed in the hands of members or partners. So typically these unincorporated JVs and members are considered as pass-through entities. So the taxation will happen not in their own hands, but it will happen in the hands of the members or the partners. However, if this LLPs or the partnership are limited liability partnership, or they are limited, the liability is limited, then it will get taxed at the entity level and not at the partners level. So here what interesting point comes out is that if a foreign company, say a company which is not in UAE, is part of a partnership in UAE, or it is part of an unincorporated JV in UAE, that company would be liable. So a foreign company would be liable to tax in UAE and not that partnership. And so that foreign company would be liable to take registration in UAE and comply with the law of UAE. Second, for a non-resident otherwise who is earning income from a permanent establishment in UAE or from a source of income in UAE would be liable to tax. Again, permanent establishment concept, UAE law has aligned it with OECD. So if you have a fixed place P, so like a foreign company having a branch in UAE, a foreign company has a fixed base in UAE, may not have a physical branch, but has a presence in form of some project or some site where work is going on, and that period of that site is more than 6 months, then it would be considered having a permanent establishment in income, would be considered as having a permanent establishment in UAE. The big thing which is provided under the law currently and which could have an impact, a very large impact on foreign companies, UAE sourced income definition. So if you look at the definition of UAE sourced income in the PCD, it says that any income earned from contracts in UAE, from resident in UAE, from assets located in UAE, activities, contracts performed in UAE, or rights used for economic purpose in UAE. So this technically covers anything which is to do with UAE. So even if you have a transaction with a person in UAE or a resident in UAE, it is covered. So it says that any non-resident having transaction with UAE resident would be taxable. So this could create a large issue for all the foreign companies doing business with UAE. Only relief here which I could possibly think is recourse to the tax treaties which UAE has entered with various countries. So say for example, an Indian company is earning a royalty income from UAE. From a UAE sourced income definition, it is taxable. So I will go and check India UAE tax treaty and see whether there is any exemption provided for that royalty income. If no, then I will pay the tax ideally as per the India UAE tax treaty 10% or 9% as per India UAE local law in UAE. But say there is an income like commission which is not covered under the treaty under FTS or royalty, then that income may get taxed because of this provision, but I may be able to claim an exemption under the tax treaty saying that I do not have the permanent establishment in UAE. My income is not taxable under the treaty and hence this income should not be taxed in UAE. However, this would have larger implication for countries which do not have tax treaty with UAE. So there are countries like US, Australia, Qatar, Oman, which does not have a tax treaty with UAE. So say a Qatari company has some transaction with UAE which otherwise was not taxable, may now become taxable because of the UAE sourced income definition under the UAE law. Currently, the definition is very wide. Representations have been made to make it more aligned to the tax treaty laws so that it is neutral for other countries which do not have tax treaties. We'll have to see what happens in the final law, but currently this could be a big area where it may create tax liability in UAE for a lot of companies which are coming from non-treaty countries. Then any non-resident having a POEM in UAE. POEM is nothing but place of effective management. So if say a UAE resident has a company outside of UAE, but effectively that company is managed from UAE itself, then they are saying that that company would be treated as a resident of UAE and would be liable to tax on its income even though it is not present in UAE. Again, POEM has been defined to say that where directors or other decision makers make key management and commercial decisions. So here it would be very important for the government or for the authorities to define or provide some guidelines for POEM. What is key management and commercial decision? Also, if some threshold can be given for smaller companies. So if you are a small setup in UAE and you have set up a company in other jurisdiction, initially you may not have an independent board in that company. Some of the decisions there would be overlap. So like in India, they have given a limit of 50 crores turnover for POEM to not apply. So some sort of threshold should be provided. Also clarity on what is the meaning of management and commercial decision. If it is provided, it will help in companies in terms of taking better informed decision and also help in creating unintended taxation for foreign companies in UAE. Then now coming to exemptions. So exemption, as I mentioned, individuals are not liable to tax on their incomes which they earn. UAE government or government-owned companies are not taxable. Businesses engaged in extraction of UAE natural resources are exempt from corporate tax. They may be have to pay tax as per the tax of the each emirate which is there as on today also. Investment funds, certain types of investment funds are not liable to corporate tax. If you have an investment manager sitting in UAE and he is managing investment for non-residents, he shall not trigger a P for that foreign residents in UAE and would not be liable to tax. Charitable organizations are exempt. Free zone companies, which we will discuss later, are currently exempt from the scope of corporate tax in UAE. So no exemption specifically it has been mentioned and no exemption would be provided to uh, charities or charitable organizations who are carrying out commercial activities on whose income or donation is used for personal gain of fiduciaries. So the second part is understood, but on the first part, there may be a possibility that I am a charitable organization. I may be doing some bit of commercial activity, but my overall objective is of a charitable institute or a charitable organization. Say I am a charitable organization doing something for people who are underprivileged, and as a part of encouraging them, I am selling some of the items which they have prepared on their own after I have trained them. So whether some kind of flexibility should be provided. Many other countries globally provide that if your overall 10% of your total corpus, if you are earning say 10% of your corpus is through a through a commercial activity, you may still be considered as a charitable organization. So even a single rupee commercial, currently it appears that even if a single rupee of or a single AED of commercial activity which is done, then the entire charitable organization may not be considered an exempt person. Obviously, representations have been made to provide some monetary threshold or some percentage threshold to give some exemption to the charitable organization. Now coming to the taxation regime. So the tax rate is 9% as we all know. First 375,000 AED would not be taxed. Any income on above 375,000 AED would be taxed at 9%. So it would be only the income in excess of 375,000 AED which would be taxed and not the entire income. Exemption, the tax on the first 375,000 would always be zero rated. How do you compute tax? First, you will have to look at your accounting profit or a book profit. Accounting profit or book profit would have to be determined by either IFRS standards which you follow or any other standard which you follow. On that, you will have to give impact of unrealized gains for revenue items. So for example, if there is a revaluation of your stock and there is a gain, then that adjustment would have to be made. But if there is a revaluation of your capital asset, that would not have to be adjusted, that would not be considered as your profits. All revenue items adjustment would have to be considered, or capital items adjustment would not have to be considered. Further, currently, while there is no withholding tax proposed by the UAE corporate tax law, but they have created a withholding tax regime. So they have said that if you are making payments to a foreign company, a 0% withholding tax rate to apply. No returns, no withholding tax return, no compliance is required. But by introducing a regime of 0% withholding tax rate, they've kept the flexibility that in future the 0% may become 1%, 2%, 5%, or 9%, or whatever the percentage is. So here the window has been kept open to introduce tax, withholding tax in future by introducing a regime but giving a 0% rate. Once you compute your book profits, then you will have to look at what is an allowable expenses. So there is no specific list of allowable expenses. They have said that any income earned, or sorry, any expense incurred for earning taxable income would be allowed as a deduction. However, they have given certain negative list. So they have said that if your interest expenditure exceeds 30% of your earnings before tax depreciation or an amortization, that would not be allowed. They will provide a minimum threshold like this. If your interest is below say 100,000 AED, that would be allowed irrespective of 30% limit. But for higher, that limit has not been provided yet, but otherwise you will have to look at your interest expense, compare it with 30% of the EBITDA. If it is lower than 30% of EBITDA, you will get the entire interest. Otherwise, there would be a disallowance of interest in that year. Second, business promotion expenses. 50% of expenses on entertaining customers, suppliers, and business partners would be disallowed. Again, what is the meaning of entertaining customers, suppliers, and business partners has not been defined. Say, as a company, if I keep a seminar in my premises or in a hotel, and I have a courtesy dinner at the end of the seminar, and it's more of a marketing webinar or a seminar for my own customers, whether the courtesy dinner organized at the end of the event, whether that would be considered as an entertainment expense, there is no clarity. How it would have to be interpreted is something which we will have to see once the final law comes, and this could be very critical because business promotion straight away 50% expenditure is disallowed. Any penalties, so any penalties you pay would not be allowed. Any donation to unapproved charities would not be allowed. Any VAT for which you are claiming a credit would not be allowed. Lastly, any payment you make as a mainland company to your group company in free zone would be disallowed. So now coming to the interest capitalization rules, interest cap rules, which we discussed in the earlier slide. They have said that these rules are introduced in line with BEPS Section Plan 4, which talks about disallowing excessive interest paid to group companies. Only problem here is that while the Action Plan 4 talks about interest cap on borrowings from the related parties and not from the third parties, and also it talks about debt equity ratio. So here both those conditions are missing. So irrespective of what is the debt to equity ratio of your company, irrespective of whether your borrowings are from third parties or unrelated parties or related parties, this law will apply. That is slightly in deviation to what has been provided in BEPS Section Plan 4. Certain exceptions are provided rightly so for banks, insurance companies, finance service activities, or business carried on by natural person from the interest cap rules. However, lending with related parties has additional condition, two conditions. One is interest paid should be at arm's length for intra-group transaction. So from a transfer pricing perspective, the interest cannot be excessive. It has to be in line with what you would have paid to a unrelated party. Plus, for specific transactions, if you have taken a intra-group loan, then there has to be a valid commercial reason to take that loan. Again, what is valid commercial reason? They have said that if the lender is paying 9% tax on the interest income, then it would be considered as a valid commercial reason. If that lender is not paying 9% tax, or it is a foreign company which is in a jurisdiction where the tax rate is lower than 9%, then what would be a valid commercial reason is not provided. It is for the companies would have to present a case to say that this is a valid commercial reason. So this would again be something which may create unnecessary litigation. One more larger point is that, say for example, if your interest is more than 30% and there is a disallowance, there is no provision to carry forward that disallowed interest in subsequent years for set off. So it may become a permanent disallowance and may result in a tax cost for a company. So it may become critical for companies to look at their debt equity situation before the city regimes comes into picture, so that they can appropriately structure this along with the projections of the business, so that they don't end up having a cost which is non-deductible permanently from a tax perspective. Going forward on tax losses, they have again, one point I missed here was that on the deduction of expenses was what happens to certain deductions which otherwise are allowable but are pertaining to pre-city regime. There is no clarity. Say for example, a mainland company made a sale of 100,000 AED to a ABC company in mainland only. Today there is no tax, so that 100,000 AED which was earned by the mainland company would not have been offered to tax. Now after 4 years, after lot of trying, litigation, legal case, you are not able to recover that 100,000 from your debtor, and you want to write off that expenditure in your profit and loss account. So technically it is called as a bad debt. That bad debt write-off is typically allowed as a expenditure in general parlance. But what happens in this kind of scenario where the original income was not offered to tax, because that point in time the corporate tax regime was not there, but now the expenditure is coming when the corporate tax regime has kicked in, whether the deduction for the same would be allowed or not. Similarly, you have to pay to someone, but because the service levels were not acceptable or for whatever reason, after 3 years you decide that you are not going to pay that to the vendor from whom you took a service, you have to write it back. Same way, whether that write back would be considered as taxable, because originally the expenditure was not allowed to you, whether that income should be taxed in your hands. So this kind of entries or accounting adjustment you need to look at prior to the corporate tax regime coming in. Take a position how you want to account it, whether you want to make a write back before the law comes in. All of that decision would need to be taken before the law comes in, so that it should not happen that you have unintended consequences in your P&L. Moving on to the next topic on tax losses. So what they have said that losses can be carried forward indefinitely and it can be offset against income of subsequent years. So if I incur a loss in a particular year, I would be allowed to be carried forward in subsequent years and claim a set off. However, set off would be restricted to 75% of the taxable income of the subsequent year. So what in essence they are saying that in any year minimum 25% tax you will have to pay. Minimum 25% you will have to pay tax even if you have huge carry forward losses. Second, they say that loss carry forward would be allowed only if 50% of the shareholding is maintained. So if I am the shareholder of 50% today, in subsequent year to claim the set off, it should not happen that I have transferred a loss making company to someone. If I have transferred that company to someone, he will not be able to claim the loss if that 50% shareholding criteria is not maintained, or same or similar businesses continue. So if that person takes over the business and then continues the business which I was doing, then he will still be eligible to claim the benefit of the losses. Again, what is same or similar business would create some challenges. Say if I am selling mineral water today, tomorrow I start selling soda, whether it would be considered same similar business Probably answer is yes. But if I expand it to selling food items, whether it would be considered same or similar business, not defined, so it could create some challenges in terms of what is same or similar business. Again, it is not defined. Same or similar business should be carried on in the years of set off, or I can say continue that business for a few years and then I stop that business and another business, whether that will allow me to set off the loss or not. So these are some of the open items which may remain. Again, these conditions will not apply to listed companies. Again, relief of tax losses will not be available if you have incurred before the corporate tax regime, or you have incurred uh, before you become a taxpayer for UAE city regime. So like for a free zone company, I may be incurring losses even in 24-25, and my corporate tax regime starts in 2030. Then I will not be able to claim losses for the years where my corporate tax regime was for earlier years. Again, if you incur losses from any activities generating exempt income, so say there is a capital gains exemption for you, and if you are incurring losses on capital gains, uh, you are incurring a capital loss rather than capital gains, you will not get a deduction for the same of a loss. Same way incurred by a free zone entity which is not attributable to the PE. So in addition to the tax losses, there is a concept of transfer of tax losses. So within a group or between group companies, if there is a common shareholding of at least 75%, then one company can transfer loss to another profit making company. So at least at a group level, you don't end up paying tax when another company is suffering and you are making profits. Again, there are certain conditions like the group company which is taking the transfer. So that in the example which I have given, company B has 300 profit in the books. So what would be allowed to be set off is only 75% of the profit of the company B, which works out to 250. And also set off is limited to 75% of the loss is transferred. So out of 250, what is eligible is only 225, because 75% of 300 is only 225. So net taxable income would remain at 75 and balance 25 would have to be carried forward. Again, there is no clarity as to who should carry forward that 25. Whether company A should carry forward, it should transfer only 225 because only that much is allowed to be set off by company B. So whether I can only transfer 225 and keep 25 with company A and company A can carry forward, or company B can take over the entire 250 and whatever it can set off, balance it can carry forward. So that clarity is currently not there. Moving to exempt income for corporates, dividend income earned from domestic companies are exempt. So if a UAE company earns dividend income from another UAE company or a free zone company, it is exempt. But if dividend is earned from foreign companies, then it is exempt subject to two conditions. That is a qualifying shareholding condition. One is that the owner should be owning that foreign company 5% or more. So shares of 5% or more should be held by that UAE company in the foreign company, and that foreign company should be in a jurisdiction where the tax rate is minimum 9% or higher, the corporate tax rate. So this leads us to a couple of situations. One situation is that any other, so the qualifying shareholding condition is provided only for shares. So for example, if a UAE company is holding a property in another country or holding interest in a partnership firm or a limited liability partnership and not shares, that will become taxable in UAE as capital gains tax. Also, if it is holding some rights like a call option or a convertible instrument, that will become taxable in UAE unless it is shares. Second, if UAE company has a business in a country where the corporate tax is less than 9%, and on disposal of those shares, it will become taxable. Similarly, exemption has been provided for income earned by non-resident from operating of leasing of ships or aircraft or other equipment if similar benefit is given to a UAE company in that country. So again, this leads us to the point that if a foreign company, say an Indian company, is holding shares in UAE company, that will become taxable in UAE because reverse exemption is not provided. This is slightly in contrary to the FAQ because FAQ mentioned that capital gains of foreign company would be exempt, but the public consultation document does not mention that. So it is possible that if treaty exemption is not available, a foreign company holding shares in UAE company may become taxable in UAE. Exemption is provided for foreign branch profit. So if a UAE company has a foreign branch, there is an exemption provided. There are two options provided. You can claim exemption of the income itself. That is, you don't include the income of the foreign branch country in your income, or you include it and then claim a tax credit. Moving on, UAE law provides that UAE residents would be subject to tax on their worldwide income. So as we say that worldwide income is taxable, there could be possibility that in the foreign jurisdiction where you are earning income, there would be withholding of taxes. So how credit of that would be available? That has been provided under the law. So the law says that the amount of tax you pay in the foreign country or the UAE tax payable on the foreign sourced income, whichever is lower, would be available as a credit to you. If there is any unutilized credit, you will not be able to carry forward that, or there would be a refund which would given to you for that. So that would become a cost to you, and that would not be available to you. So this is a simple rule given for foreign tax credit. There could be many issues in terms of how to compute UAE tax payable on the foreign sourced income. Typically, wherever there is this law on foreign tax credits, they provide certain rules, mechanism on how to compute foreign tax credit. I think so something of that sort should be provided to avoid confusion. We've taken one example to explain what could be the possible issues which may come. So one example is that, say for example, a UAE resident is earning 700,000 AED in UAE and it is earning 300,000 AED in a foreign country. So total worldwide income earned by that is 100,000 AED. Out of that, total cost for earning that income, assuming all allowance, disallowance has been taken care of, works out to 600,000 AED. So this 600,000 AED, the tax comes to around 20.25. Now you have to look at how to claim foreign tax credit. So there could be two scenarios, right? One is the tax paid in the foreign country. Say the tax paid in the foreign country is 15. Now second condition is you have to see UAE tax payable on the foreign sourced income. How do you compute UAE tax payable on foreign sourced income? One scenario could be that you actually figure out what is your expenditure incurred to earn that foreign sourced income. So say your income was 300 and you are able to actually prove that to earn that 300 income, my actual cost is 150. So on that balance 150, you calculate 9%. Again, on that 150, whether the initial exemption of 375,000 AED needs to be taken, not taken, not answered as of now. But if I take 9% on that 150, it works out to 13.5. Scenario 2 is that you calculate an average tax. How do you calculate an average tax? You look at your tax, that is 20.25, divide by your taxable income, that is 600, then average tax will come to 3.375%. You apply that on your foreign income, that is 300, then it will come to 10.30. You see, under both the different methods which I applied, there is a substantial difference in what credit you will get. In one case it comes to 13.5, in one case it comes to 10.13. So which method to be applied, how the tax on the UAE sourced income from foreign source needs to compute it would require some bit of working and also some bit of clarity so that right amount of tax can be determined by the company. Coming to free zones, for simplicity we've presented it in a diagrammatic form. So there are two cases. One case is when in what cases free zones companies would be taxed at 0% rate, in what cases it would be taxed at regular income or corporate tax rates. So in order to get taxed at 0% tax rate, free zone companies have to ensure that transactions with businesses, they carry out transactions only with businesses outside of UAE or in other free zones. And if at all they are earning income from mainland, it should be restricted to passive income like dividend, interest. Of that sort income only has to be restricted. If you are earning income from your mainland group company, then you may continue to get the 0% exemption, but your mainland group company will have to disallow that expenditure in their books of accounts like we saw. Then you will get an exemption. If you are a free zone company located in a VAT DZ zone and the buyer is the mainland company, but he should be an importer on record, then the sale of goods to the mainland person who is importer on record would not be liable to tax. So the free zone company will still enjoy the exemption provided. However, if the free zone company does not have economic substance or is in non-compliance with regulatory requirements, which includes you to get your books audited and things like that, then you will lose out on your exemption. So technically, one is you need to have economic substance. Again, what is economic substance? Not defined, but I presume they will rely on ESR regulations. If you are complying with ESR regulation, then it would be considered as you are meeting the economic substance test. Non-compliance with regulatory requirements could be wide. So if you are in a say particular free zone, DIFC, DMCC, and you are not fulfilling the condition of that free zone, which could be getting your accounts audited, renewal of your license, not doing activities which is beyond your license which is provided. And if anything of this comes to the notice, the entire exemption which was given to you can be revoked and you may become liable to tax under the corporate tax regime. If you have income from transaction with a mainland branch of your own branch, then that will become taxable, but only that income would become taxable. Other income of the free zone company would remain not taxable. However, if you have any transaction with a mainland company which is other than passive income, then all your income will get taxed. Not only the transaction with that mainland company, but all the income of the free zone company would become taxable. Free zone company, irrespective of whether they are liable to tax or not, are required to obtain the tax identification number and file tax return. They have an option to choose to come under the regular tax regime. Once they come under the regular tax regime, that option cannot revoke, so they cannot go back. So like we discussed about EAR, ESR, second is one of the condition was meeting the regulatory requirement of the particular free zone. Say for example, you have not met certain conditions of the free zone regulations, but you are able to rectify it by making a payment of penalty or a late fee. Then whether it would be considered as not complying for the corporate tax purposes and you would disqualify for 0%, there is no clarity, at least to me, how it would be treated. Again, when you are earning passive income from mainland source, sorry, other than passive income from mainland, whether it would be for the year in which you did the transaction, your entire income will become taxable, or it would be for the entire period for subsequent years also. The wordings indicate that it should be for the entire period going forward as well. So it will mean that you may lose out on the exemption of the free zone companies because it says that you will fall under the regime of corporate tax. The wording says when you fall under the corporate tax regime, I believe the entire exemption would be revoked. Moving on to tax groups. One of the options provided under the law is that as a business group or as a large group, you may want to not get into multiple level of compliances and they allow you to form a tax group. So if all the holdings, common holding ultimately or the ultimate holding between the group companies is more than 95% or 95%, then everybody can come together and form a tax group. That entire tax group would be treated as a single person, taxable person. Single level compliance would have to be done, and additional subsidiaries as and when you set up, that can also join the tax group. Only part is that business group consisting of exempt person and free zone person who are benefiting from 0% corporate tax cannot form a tax group. So as a tax group, you will have to analyze whether your free zone company wants to give up the exemption and then become a part of your tax group, if there are larger synergies from a compliance perspective, and also if there is a opportunity of merging losses of a free zone company with a mainland company, or from a efficiency and a compliance perspective. So all those decisions you would have to take and then register for a tax group. Moving on, certain reliefs are provided for intra-group transfers of assets. So if there is a transfer of assets between group companies where the ownership is more than 75%, there would be no taxation on transfer of assets. They have provided that this transfer should happen at tax net book value, and hence there is no question of profit or loss to the seller entity or to the buyer entity. Gain loss to be computed and taxable in the hands of transferor if the condition ceases to meet within 3 years. So if I did this transaction and post that if I don't hold 75% ownership, then there would be a taxation levied on the first transferor. Similarly, big business acquisitions are exempt, but condition is that on transfer, the third party, if within 3 years you transfer it to a third party, there may be a taxation in the year of transfer to the third party in the hands of the first level transfer which had happened. So for example, a specific exemption has been given under the law for a natural person. See, today I'm doing a business as a natural person without having any setup. Now I decide to set up a company. I can transfer my entire business which is there in my commercial license to a company. This transaction would not be taxed because a specific exemption has been given. But then I sell off that company within 3 years to another third party. Then in the year in which I do that transfer before the 3 years, the income of the original transfer which I made to a company would become taxable. Then coming on transfer pricing. So on transfer pricing, they have said that transfer pricing would be broadly aligned with the OECD guidelines. Any transaction arrangements between related party and connected person would have to comply with transfer pricing guidelines. Arm's length principle would have to be determined based on internationally recognized transfer pricing methods. So in sum and substance and in summary, any transaction you are doing between related party or connected person, the transaction cannot be at a value which is different than what you would have done with your unrelated party. So if I would have, say I am selling goods to somebody outside of UAE at $100, say per item, per unit, but I'm selling the same goods to somebody in UAE at $120, then there is a possibility that $20 would be added to your income, saying that there is a differential pricing provided to a related party, which is resulting in eroding the tax base in UAE. So if you would have sold it at $120, which is a general price to an unrelated party, that additional $20 would have become taxable in UAE, which is not becoming because you are pricing the transaction at a lower price in case of a related party transaction. Again, there would be disclosure requirements of related parties and connected person. You will have to file a master file, a local file. Local file would be more explaining each and every transaction you are doing with your related parties, both internally, domestically, as well as internationally. What are the transactions you are entering, how those transactions are at arm's length. Master file would be at a global level, which you will have to maintain, and you will have to comply, and you will have to report all your global transactions as well. Related party and connected persons have been defined. Related parties from an individual related up to fourth degree of kinship by birth, marriage, adoption, or guardianships are covered. Direct indirect control of 50%, common ownership, branch, partners, exempt and non-exempt business of the same person. All of that are covered as related parties. Again, there is a concept of connected person. So individuals controlling on taxable business are director or officer. So your salaries or anything you are paying to a director or an officers has to be at arm's length. It cannot be a higher, because the logic is the director who would be earning that salary is exempt from tax, but the company will get a deduction of that salary expenditure. So it has to be in line with what is the arm's length, what is actually, whether the services which he is providing, whether that deserves that salary. If there is a sleeping director in a company who is not actively in the business, involved in the business, but is getting a hefty salary, then that can be challenged, because the company would then have to justify his role in the business for paying such high salaries. Now coming to the tax administration. On the tax administration side, all companies would have to get a tax registration number from FTA. If some company is liquidating or closing down, they will have to deregister themselves within 3 months. From a tax authorities audit perspective, they will in general follow self-assessment principle. Whatever you file your tax return, they will consider has been assessed by yourself and filed. Obviously, there would be procedures where the FTA would have an opportunity to scrutinize your tax return filed in detail. Also, for free zone companies, in order to claim 0% corporate tax regime, benefit of 0% corporate tax regime, they will have to get their books audited. If any transaction you are entering into where you don't know what is going to be the tax implication, there is an option available to apply to the FTA and get the transaction clarified. Once a clarification is given, that shall be binding on the FTA. So at a later date, they cannot challenge that transaction. Return from a compliance standpoint, currently there are no provisions on withholding tax or payment of advance tax on a quarterly basis. Only you have to assess yourself after the tax period is over, and within 9 months pay the tax and file the tax returns. So to give you an example, if your financial year today is ending on 30th June, your tax period will start from 1st of July 2023. If your tax period is ending on 31st December, then your tax year will start from 1st January to first tax year will start from 1st January 2024. And if it is 31st March, then your first tax year will start from 1st of April 2024. Now coming to implications of Pillar 2, like we all know that the Pillar 2 provides for a minimum global tax of 15%. So currently the tax rate provided is 9%. So large companies, obviously there has been option kept open in the UAE corporate tax rate also, whereby it is likely that if assuming all companies are treated equally and only 9% tax rate is applied, then the other countries would have right to recover the balance 6% tax in their home country. So in order to protect their own tax base, I'm sure UAE will come up with a 15% tax rate for companies where Pillar 2, the minimum turnover criteria, is applicable. They will implement 15%. Second is for large groups globally, where the minimum globe tax rules are applicable of 15%, are having companies in free zones which are eligible to 0% corporate tax regime may still end up paying 15% tax on the profits earned by the free zone companies in their home country, because 15% would not be available to this free zone company, and hence they will have the right to recover that 15% in the home country. So with this, I end my presentation. I'll take a couple of, I think we have 10 minutes. So I'll take few case studies just which will give you a flavor of how the law will look like, what could be the possible scenarios. So typically, if you have to do a computation of your taxable income for UAE corporate tax, so in this example, let's say the sales is 12,500. Out of that, you will deduct all the expenditures in your accounting records, which are there to come to a accounting net profit. So you may have depreciation, interest on borrowing, payment to free zone subsidiary, business promotion expenses, other operational expenses, and that's how you derive at your expenses of say 8,700, and then you come to accounting net profit of 3,800. Then you start looking at what are the disallowances I need to make. So first is, say for example, as we mentioned earlier, payment to free zone subsidiary, which is claiming a 0% corporate tax rate, is not allowed. So straight away you will have to add that expense back because that is not an allowable expenses. Then you are making payment of interest on borrowing. So you will have to first figure out what is your EBITDA. So to figure out your EBITDA, you will add 3,800, you will add the depreciation, interest. So you will come to a figure of 7,500. On that you will apply 30%, which works out to 2,250. But your actual interest paid is 2,450. So 2,450 minus 2,250, 200 would be disallowed under the interest cap rules. This 200 would be, like we mentioned, a permanent disallowance. There is no option to carry it forward. Similarly, if your books have something known as business promotion expenses, straight away, without getting into details, you will have to disallow 50% of it as per the law. So this will work out your total disallowances. On that, you will then finalize your taxable income and then apply the tax rate, which will effectively work out to 495 on accounting net profit of 3,800, which effectively is higher than 9%. But if you look at your taxable income after disallowance, it works out to 5,875. Second case study is on the exempt income. Mainly dividend and capital gains exemption has been provided. So say for example, if a UAE company is holding 30% in a foreign company known as PQR, and the tax rate in the country where PQR is set up is more than 9%, then any dividend received from that PQR company, since it is satisfying both the conditions of more than 5% holding as well as greater than 9% tax in the home country, you will be able to claim exemption of the dividend in UAE. Similarly, if you are holding only 3% in a UAE company, you will still get the exemption from dividend because the qualifying shareholding condition does not apply to the local companies or the free zone companies. Now coming to capital gains example, same example, but only difference is that the company DEF, which is there in the foreign country, the tax rate is 0. Then there would be a problem because you are not satisfying the second condition of 9% or higher tax in the home country. So if you exit that shares of that company, you may end up paying tax in UAE. So here you may have to look at your group structures, whether it is educate, whether you may want to interpose a holding company above DEF, which is in a country where tax rate is higher than 9%, but the capital gains tax exemption is available, say something like Singapore or Mauritius, so that ultimately when you dispose of DEF, there are no issues in terms of paying capital gains tax. So all this is structuring which you can do before your law comes into picture. You will have to look at your structures in this manner to see whether any adjustments are needed to be made. Then we discuss about branch profit tax credit. So there are two methods provided. Again, if you have branches outside of your country, you will have to look at which method to be applied depending on the tax rates in that country, because both can give different result depending on which country you are and what is the tax rate in that country. Say for example, if you are in a country where the tax rate is say approximately 20%, sorry, this 40% is a typo, the tax rate is 20%, then your branch income, the tax would work out to 100, whereas UAE tax paid is 146. So if I take the tax credit method, I would be worse off because my taxable income would become 2000, my tax would become 146, and credit available would be lower of the actual tax paid 100 or the average tax rate of 36.56. So my taxable income may come to 109.69. Vis-a-vis, if I go to a exemption method, I will exempt the entire income, offer only 1500, and my tax would be 101 instead of 109. Obviously, if the tax rate is 5% in that country, the results would be different. So whether for different branch, different methods can be adopted, or which country, which method to be adopted is something you need to decide before the law comes into place. So what is the way forward for company? As I mentioned, there are a lot of areas which needs to be looked at. So before the law comes into picture, you should carry out a thorough tax impact assessment of your group, whether you have the right holding structure, right operating structure, right capital structure, whether any advantage can be taken or whether any unintended implication can happen because of the way you are structured currently, and whether you can correct it before the law comes into place to save on the unintended consequences. Look at your related party transaction globally as well as in UAE, whether there is possibility to put in place a transfer pricing policy as on today, which will help you to cater to the transfer pricing requirement which will come in shortly. Analyze implication on high risk intergroup transactions and see whether any changes needs to be made, whether any transferring of assets needs to be done, or whether some transaction needs to be discontinued. All those thinking has to start now, because suddenly when the law comes out, you may not have a lot of time to think through all of that. And prepare yourself for compliance and documentation, whether you need to follow IFRS, whether you have some accounting system being followed currently, whether that is sufficient. How are you looking at your record keepings? What is happening under VAT, whether that can help you under corporate tax. All that needs to be looked at so that you are prepared for the compliances. So with this, I would like to end my session. I hope the session has been useful to you, and I have been able to add some value on the subject. Thank you. Thank you, Ashish. You can we can take over the questions.
Sure. Thanks, Nishit. Thanks, Kruti. Yes, informative session, and the case studies actually threw light, even for a layman, with respect to how a tax perspective should be looked at in the corporate sphere. We do have some questions, and I see a couple of hands raised. So I will start with the question from Soumya. The question is for TP, whether free zone entities and mainland subsidiaries would be covered.
So yes, for see any which ways the transactions which are going to happen between mainland and free zone, if they are forming part of a related party definition, yes, the transfer pricing would be applicable.
Okay. And the next question that we have from Soumya is on one of the slides wherein 0% tax for sale transactions in VAT free zone. What is the method for non-physical goods, that is software, because they don't have an importer on record mentioned?
So unfortunately, very limited detail in 2 lines has been provided under the PCD. So how important the importer on record condition is, we will be able to figure out only when the law comes out, and if it continues the way it is, then probably we may have to invoke the option of taking a clarification from FTA, whereby we can write to it that the transaction is exactly similar, but only thing is because of the kind of transaction which is non-physical, there is no concept of importer on record, and hence similar kind of exemption should be granted. That's my view.
Thanks. Tax exemption versus tax credit. Isn't exemption taken once applicable lifelong with no option for changeover?
Yes, that is the law. So if you first opt for an exemption, then lifelong you will have to opt for that. So the idea of the case study was that you need to look at the larger level projections, and you should not be influenced by the outcome of the year one. In year one of the method may be beneficial, but if you look at in long run, you may get some different results. Also, whether the option for different branch, I can have different options or not, that is something you need to evaluate.
Thanks. Soumya, these are the questions that I could see. I'm unmuting you in case you have any other question. Otherwise, we'll move to the next question. I've just unmuted you, Soumya.
No. Thank you. That's all from my end. Thank you.
Perfect. So, Nishit Trupti, the next question is from Vishwanathan. What about a parent company outside UAE taking interest from a UAE company?
So UAE company, there is no definition provided as to it has to be related party, unrelated party. So forget even parent company. Any company you give loan to, you take loan from, and you are paying interest, then you will have to look at a deduction condition. If you have taken a loan, if you have given a loan, there is no condition. Obviously, the TP would apply. So there are two aspects, right? If I am paying interest, I am receiving interest. If I am paying interest, then I have to look at that 30% condition of my EBITDA. But if I am receiving interest, then from a transfer pricing perspective, if I am receiving interest at 2%, whether that is at arm's length or not, if it's a related party transaction, I will have to benchmark that and prove that 2% is at arm's length. If 5% is at arm's length, then 3% would get added to my income.
Okay. Another question from Vishwanathan. What about depreciation? Any specific percentages given for tax calculations?
No, so as of now, no specific percentages have been provided. So we'll have to see whether for tax purposes, if specific percentages are provided, or they may provide to take it from the company law or the law which provides for the tax rates. So as of now, to answer your question, no rates are provided.
Sure, thanks. Next question is from Sandeep Mukherjee. If my financial year is April to March, then will my first year for UAE tax be from 1st April 2023 or 1st April 2024?
1st April 2024. So the law says that any financial year commencing post 1st June of 2023. So your first year would commence only on 1st April 2024.
Sure. Next comment from Ayush Agarwal. Hi Nishit, thanks for the wonderful overview. While we can gain this knowledge from a lot of forums, how do we actually decode the consultancy market?
So I actually did not get the question exactly. You want to repeat that? Sorry.
Sure. So thanks for the wonderful overview. While we can gain this knowledge from a lot of forums, how do we actually decode the consultancy market?
Decode the
consultant. Yeah, that's a consultant talking to a consultant.
Yeah, so
I will connect you with the respective audience. Next is from Shweta Agarwal. Will transfer pricing also apply for transactions between free zone company with another group company outside UAE?
So this is an interesting question. Probably answer is not so clear. So technically, if the free zone company is not falling under the tax net, then technically there is no, even if there is an addition made in that free zone company, there is no revenue addition to the government's kitty. And in other countries also, if the transaction is not resulting in any specific income generation, then it should not be applicable. There is no clarity in the law. This suggestion has been made to keep them out, but as of now there is no clarity. But I would go with the view that it should not apply, because ultimately there is no benefit of doing the compliance and getting it through, right?
Will all the free zones now have to go through tax audits annually?
No, so they have said that audit would be required to claim 0%. So whatever your books of accounts are prepared has to be audited. The audit by the tax authorities or the FTA would be not necessarily annual. They will select depending on various criteria which they may have to select a particular case for a detailed revenue audit.
Okay. Next question is from Sunil Ahuja. Hi, good afternoon. Thank you for the informative and knowledgeable session. The query is, if our company financial year is October to September 2023, then what will be our tax year and when will be our first tax return due?
So your period would start from October 23 to September 24, and plus 9 months would be your date for filing return, and paying taxes.
Okay. Second question from the same participant. Under what scenario the companies have to pay 15% tax?
So there is a turnover threshold provided under Pillar 2 as to where the 15% tax rate would be provided. But as of now, UAE has kept the option open that for the companies where the turnover exceeds that limit, then only 15% rate would apply. But again, they have not come up with a 15% rate yet. The turnover limit which is provided is I forgot the number just now, but I can write to you.
Sure, I will connect you. The third question from the same participant is, if the UAE company has invested in Indian share market, and in case UAE company sells shares in India, then what are the tax implications in the UAE?
So if you are not holding 5% in the Indian listed company, then it would be liable to tax in UAE at 9%. However, in India, any which ways it is taxable. So you will be able to claim a tax credit on the same. And effectively, there may not be any impact because in India, short-term capital gains is 15% and long-term is 10% for individuals. So effectively, you may not end up paying any tax because you may be able to offset the credit.
Okay, thanks. Next question is from Udit Shah. Any detailed regulations provided for a foreign branch of Indian company to shift its operations from mainland UAE to free trade zone, so to save claim tax exemption?
So there are no regulations provided, but I think so. This is possible. Trupti, would you want to take this up? Whether there is a possibility of shifting it, or they may have to close that and reopen a new one in a free zone. I think so. Her screen is.
Her screen is frozen, but she's connected.
Okay.
We can come back to this question once
Sure.
she is connected. Next question is, hi Nishit, thanks for the presentation. Does the 50% on promotional expenses, including marketing expenses incurred for trade show and digital marketing?
So there is currently, as I mentioned in my presentation, they have just mentioned that business promotion done for the clients involves some element of personal expense, and hence we are proposing a 50%. So that's why, in fact, my case study or my presentation had that wording, what is business promotion is very important, which is not defined. If digital marketing event is done, which is to promote your product, where is the question of business? It is a business promotion, but there is no benefit to the customer. But if you after the event host a dinner, then whether that is business promotion or not, that's a question. So there is no clarity as of now to answer your question.
Sure, thanks. Next is from Shweta Agarwal. Will the ESR regulations continue to apply for mainland companies or also to free zone companies which is not eligible for exemption anymore voluntarily or for other reason? Will it still be liable to comply with ESR regulations?
My personal view is yes, because the overall perspective of UAE is that they should not be seen as a tax haven which provides entry to companies which come there more from a tax perspective rather than from a need perspective. So to have a substance proves that you are coming here because there is a business requirement and not because of other consideration like tax.
Thanks. If the UAE company is following lease accounting under IFRS, wherein the entire amount is shown as income in year zero, but lease revenue are entered, are any adjustments proposed in tax law?
No, so the point for debate or discussion is that currently the government has provided that you can follow IFRS or any other accounting system for small taxpayers. So this may create challenges as to how the treatment may happen for items which are depending on the accounting systems followed recorded in 1 year and the impact comes in subsequent years. So no clarity has been provided. We will have to guided by the principle of accounting and logically look at from the experience of how commercially it makes sense from a tax perspective.
Sure. Will there be any reconciliation between VAT returns and financial statements, statement returns in UAE after the corporate tax implementation?
So nothing like that is mentioned, but yes, obviously it should be, right. That should be there.
So, Nishit, I see that Trupti, I guess she had some technical issue. I can see that she's not connected. That question, do you want me to connect you via email with Udit Shah for the
Sure.
regulations
And then we
question?
can reply to him. Yeah, sure.
Sure. Next question is from Mayur Shah. Fund and fund manager both in mainland. Fund manager earns management fees from the fund, which in turn has few investors from the mainland. Will the fund management fall under the tax scope?
Sorry, you'll have to come again slowly on that question.
No
There are a lot
problem.
of
No problem. Sure. Fund and fund manager both in mainland. Fund manager earns management fees from the fund, which in turn has few investors from mainland. Will the fund manager fall under the tax scope?
So I think so the exemption may not be available. However, this will have to be examined in detail. I may not be able to answer immediately, but I will have to look at this carefully. I may not want to answer it right now, but I can connect with Mayur and I can
So
answer to
Mayur
it.
has, yeah, Mayur says it's not mainland, it's free zone.
Yeah, then free zone
Fund
there
and
are
fund
subject to, if it is free zone, then there are subject to 3 condition or 4 conditions which are provided under the law. If you are able to meet that, that your investors, uh, there is no group of 5 or fewer investor having 50% or economic interest in the investment fund. No single investor has more than 20%. All of that conditions are met, then you should be able to claim an exemption. So a little bit of fact-based analysis can be done and answer can be derived.
Thanks, Nishit. So I don't see any more questions or any hand raised. Audience, in case you want to ask any question, we still have few minutes. While you think through on the question, or if anybody is keying in the question, we'll quickly take the feedback of the session. And in case after the feedback poll, we don't see any questions, we would close the session. Each question will be there on the screen for the audience for 15 seconds. First question on the screen. Second question. Sagar, I can see your question. Just give me 1 minute. Third question. Second last. Last. So question from Sagar Shah, what are the TP compliance requirements and any format for TP study report?
No, so they have said that you have to do the compliances as per the OECD guidelines. So a master file, a local file, uh, if it is meeting the OECD requirement, it should be good enough.
Thanks. Mohammed Sabir Hussain, I see your hand raised. I've unmuted you. You'll have to unmute from your device, please.
Hi, sir. How are you? Thank you so much for this wonderful webinar and all the information shared with us. And actually, unfortunately, I missed more than 70% of the webinar. So, is it possible if I will be able to get a copy of recording and all?
That I will let Nishit and his marketing team decide. You will receive a communication from Next Dine team later this week, and I think you can directly interact with them for that, Mohammed. Vishwanathan, I see a question. When we say 75% of the losses can be carried forward, does it mean the balance 25% of the loss shown on which tax has to be paid?
So in that year, yes, 75% can be carried forward. So the idea is that minimum in a particular year, 25% would have to be paid tax on. No, so loss transfer is 75%, loss carry forward is set off is 75%. So you can carry forward 100% of your loss. In next year, if you have a income, out of that 75%, you can set off, balance 25 you can again carry forward. So the logic is that in the year of profit, you pay tax at least on 25%. And it is not that 25% is lost. In the lost year, you have to pay tax. That is not the law.
Sure. Thanks, Nishit. Udit, so I will e-connect you with Nishit and he'll be able to take your question up. Nishit, I thank you once again for your time and taking us through the session and addressing all the queries. Audience, any question that comes to your mind, anything around UAE corporate tax and you wish to connect to Trupti or Nishit, feel free to write to them. We will share their coordinates as well with you. Thanks, Nishit.
Thank you, Ashish. Thank
Bye.
you. Bye. Thank you, everyone.